Dr. Stephen Nash from FIIG Securities is standing by. Top of the morning to you, Stephen. I mean, really, this is, I guess, an instinctive interpretation you could give that the longer this runs, the harder it gets to justify broader economic growth. What's your view?
Yeah, I think the implication is that these tensions are becoming more regional in nature, and that elevation of the oil price is effectively a like acting like a tax or a tightening of monetary policy, and may constrain growth. That's basically the interpretation the equity and bond markets are taking right now. There could be, I suppose, more medium-term impacts if that elevation of the oil price was to be more permanent in nature and then feed into inflation. But right now, the impact is really one of lower growth.
We've seen airline stocks that always take a hit on this, particularly coming out of Asia. You looked at that. That was noteworthy in yesterday's session. When you say it's regional in nature, it does cross continents. We know Europe in particular has got a vested interest in this. Italy, a huge customer. Germany. What does this do to the continued growth profile of Europe's largest economy?
Well, I think even before these tensions, the growth profile was quite flat, and given the recent problems with the region for the oil price, I think that generally the growth prospects are even lower, and they may even dip into that negative territory, which I think the whole European region would be very disappointed with.
What role then for OPEC in this environment, and what role as well to look at alternative sources of energy?
Yeah, I think the search for other alternatives to oil has been going on for some years. The green push is there, and we're finding new sources of fuel and other sources apart from oil all the time. So those developments are proceeding, but the problem is right now we still have a large dependence on oil, and that will influence growth.
Offsetting that as well, this continued consumer caution. The Assistant Governor Philip Lowe here in Australia just last week flagging this one. What was he really saying?
Well, I think that he's indicating that the consumer caution is not it's not ephemeral, it's not temporary, it's something that's been going on since around 2000. A lot of commentators have dismissed it as being temporary. I don't think it really. I think the RBA is not doing that. Also, I think Lowe pointed out that investors are starting to prefer more conservative investments. That includes cash and fixed income. Now, on the fixed income side, we've had an announcement today about the Bendigo and Adelaide retail bond issue. Now, that issue, it's around $250 million. For that organisation, it's quite a significant funding source. I have mentioned previously that retail bond issuance is going to be important for banks, but I think for the smaller banks it's going to be a bigger issue than for the larger banks. I mean, you can compare that to the CBA deal of about $500 million. This organisation is much smaller than CBA, so this is a relatively important issue for them.
What sort of appetite will investors have, though, Stephen, given this still lingering concern that we've got too big to fail locked into the system, but heaven forbid those smaller entities are still, even on a global plane, they don't look safe as houses. That's the perception, at least. How does that feed through into retail investor appetite for these offerings?
I think from the government's point of view, they are providing support for this lower tier of the banking system. I think the government is firmly behind this lower tier of the banking system. If there were any problems, I'm sure there would be adequate support there. So I think from the government's point of view, this is an important area for them. They want more competition in the banking system, and I think the support will be there.
Does it have to be, though, made more explicit in this environment? Is it enough to say, well, it's understood and it's implicit? Do they need to go on the front foot, the government?
Well, I think the more explicit guarantees would involve fees and charges and other things, and I think that the government's looking at those at the moment, and I imagine that there will be more explicit guarantees going forward. But I think it's quite difficult for them to announce a series of those right now. It also would have an impact upon the rating for the federal government as well. I think they're closely monitoring what's going on in the US and other jurisdictions as well.
What about China? Very close to home and a big consideration on all fronts. It seems as if domestically their markets have shrugged off the latest intervention by government. Yeah. How do you read that response?
Well, I think the tightening was basically anticipated by markets quite well. I think this tension in non-democratic systems in the Middle East may have some impact on China as well. I think that the Chinese or the rank and file in China may have concerns about what's going on over there, and there may be force for change. I imagine that that'll be contained in the short term, but it's a more a medium-term issue for China. More democracy, I suppose, it will be demanded over time.
Do you see this as going viral? I mean, suggestions were being made to me last night, even that perhaps even Russia could be in the firing line.
Yeah, well, these changes and the demand for more democracy, I suppose it's more a global issue now. There's been a lot of mention made of how the internet's playing a role in this these protests, and I imagine that applies to a lot of other economies, including Russia and China. Yeah.
And we're talking, though, are we not, about cultures, generation on generation, who have known nothing but, though, dictatorship. Are you not surprised that they cast that aside for such an unknown alternative?
Look, I think central planning in the Chinese situation has served them very well for the time being, and I imagine that nothing's really going to change in the short term. But I think the trend towards democracy is more inevitable, and it's a question of when it's introduced rather than if. Yeah.
Well, we can speculate all we like. Events do, of course, prove always ones to surprise. Let's talk, though, about what's going on in the UK meanwhile, because inflation there looking as if it's unavoidable, that the Bank of England will have to stamp on it and raise rates. If so, when so?
Well, there's been discussion of a rate hike in the UK at around May. I imagine if they were to move, it wouldn't be probably before August. I think they need to see whether or not the commodity price and currency issues are starting to fit in through into the general price level. At the moment, I don't think that's really occurring. So they also have to monitor growth very carefully there, because they do have a lot of fiscal tightening going on, and that's going to impact their economy quite severely in the next few months.
How important is Wednesday, because they're going to be deliberating then, are they not, this week? What sort of remarks, what sort of opinion do you see as shifting in that meeting?
Look, I imagine that they'll be setting out the risks for inflation and what they need to do in the future, but also, focusing on the medium and short-term growth prospects in the context of this severe fiscal tightening. I think they've only just begun on this fiscal route, and there's going to be quite a lot of pain as a result. So they have to focus on that, I think.
And briefly, finally, too, the focus for Ben Bernanke, the Fed chief, when it comes to jobs and this growing chorus of views that certainly there'll be no tightening until that headline number falls into perhaps a digit with an 8 in front of it. What do you take away from that?
Well, as I've been saying a few times, I think that Bernanke will not tighten too early. I think that the lessons have been learnt from history that doing that would place the economy at a possibility of another double dip. We have had a very strong rally since 2009 in the equity market. I think at this point, tightening may be the thing that could prick the bubble and get us back into another recession. So I imagine that he'll hold on the current course for monetary policy and keep policy quite loose and allow that recovery to gain more momentum, and it needs to.
Right, watching brief on that one. Dr. Stephen Nash, many thanks indeed.
Thanks a lot. Bye.
Stephen Nash there from